Welcome, everybody, to another episode of Arthur's Roundtable. Thanks for joining us today, and super grateful and big thank you to everybody that's paying attention, sharing, and we really, really appreciate it. So big thank you. So this is all Pam's fault. You're going to find out in a minute why, and we're going to talk to Rodrigo of Wealthie. And so we're going to start with Rodrigo and give us a little bit of who you are, your origin story, just a quick intro. Then we'll go to Pam, and then we'll start back with you again, Rodrigo. Okay, cool. Thank you for being here.
Yeah, it's my pleasure, and thanks for having me. So my story is, I joke, I watched that Ben Affleck movie, The Accountant. Turns out nothing like that. I decided to ditch that career and went to Wharton for business school, and then started working at BCG, where I helped build the firm's very first perspectives on fintech, crypto, and now what people call AI. Back then, algorithmic underwriting and machine learning. And I got laughed out of my very first client meeting. I got told fintech is fake, crypto's fraud, computers will never replace humans, and to go make slides. And I still had a lot of student debt. So slides I went and made. But while I was there, I helped build or rebuild Wells Fargo's home mortgage origination platform to help fend off of the attack from Rocket. As a result of that work, ended up moving down to Chile and building like a multi-billion-dollar consumer lending book, and then found that I had a love for startups after building an accelerator while at BCG. And I just said, I got to take the plunge. And so for the last, call it 8.5 years, I've been a venture-backed exec. Most notably, I was the CFO of BitGo, which just IPO'd in January. And I was part of the founding custodian team. And so we built that from 0 to 60 billion in about 2 years. Over my career, I've raised a couple $100 million and exited kind of multiple companies, turned them around. And now building Wealthie.
Awesome. Thanks for that. And it's no accident that Pam found this, because she's really good at this. And you'll find out here. Pam, thanks for coming on and introducing us to Rodrigo and Wealthie.
Wow. That is the best part of, what we do is connection. So, and thank you for having me back, Arthur. Our last podcast has turned into some great work that we've been able to do together, and that's what it's all about. So for the audience, I'm Pam Citron. I am the CEO and the founder of the Founders Arena. GFA, as we call it, was built under one simple idea. Great companies don't need more programming. They need the right people in the rooms. So our goal was to look at later stage founders. And I say that we're not later stage in the sense of maturity and where they're going, who are either slightly commercialized, ready to commercialize, looking to raise capital, build strategic partnerships, so we can enable them getting in front of the right people faster and move the business forward. And also what I find is a byproduct of that is that when you've got your founders and we've got it for a week in a room and they may be met with a Wells Fargo or a JP Morgan or Fidelity or any of the people that support our programming, that also sparks their ability to sell. Right? It gives you energy. It gives you more strength when you're really getting in the rooms. They get in their own rooms, but multiplying that just gives that energy to the founders. But most importantly now, with AI on the rise, our job is not, we can't find the best, but we do have to remove the hay to find the needles, right? So as we're looking at removing the hay, right, that's what we want to do for organizations. They can't do it as fast as we can. So it's not finding the needle. It's really accelerating those that have the most potential to get them focused on human beings' relationships where they matter most. And, I don't have favorite children at home or anywhere, but I will say that, Wealthie is a favorite in there because it did it's slightly different than just tech, right? So they're a great example of what we do. And our role isn't telling founders how to build their companies. It's trying to understand where they're going, to accelerate, open the right doors for them, not just during the one-on-one time they spend with us, but we consider them part of our ongoing family, most of them, by the way. So success is about outcomes. Trust is about introductions. People trust people that they know. So introductions, customers, capital, partnerships, and long-term sustainable businesses that we can help fulfill and build in wealth management. And thank you very much. And Rodrigo's been just great to have in the program. And the feedback has been really good.
Great. Thank you. It's really interesting that sometimes people are focused on just raising capital and they forget that it can come from a customer, right?
Yeah. I'll share like for us specifically. So what does Wealthie do? And it'll tie kind of into that exact point. So we tell folks we solve the single greatest problem in American wealth. And that is that home equity is $15, $17 trillion asset class on homeowners' personal balance sheets, but outside of modern wealth management. And Wealthie is the first and only SEC registered investment advisor that allows a homeowner to invest a portion of their home equity into other assets. So like bonds in a mutual fund or ETFs and so on, without the use of debt, monthly payments, or interest charges. We effectively unlock home equity for wealth management to help clients do more with what they have, and their advisors help them hit their goals in more creative ways. And to your point, like, hey, money can come from clients. Actually, the guy who led our first fundraise is Marty Bicknell, the founder and CEO of Mariner Wealth, and it was through his family office. And talk about someone who could potentially open up client doors and kind of opportunities there. And so that was massive for us. Was we said we don't want to go down the traditional VC route. Let's actually go down the client route, the customer route, the folks who know this industry and who can be valuable both as a potential future client, but also just as like a key expert in kind of what you want to build. That's the best type of investor in my view.
So in that case, aside from participating in the success of Wealthie, he saw it as a potential deal flow for his platform, right? Where he could manage some of the money that came out as a result of this. Is that fair to say?
Yeah. And I think this is kind of the conversation that we have with every single advisor, which is, hey, advisor, you're overworked. You're struggling to find new clients. It's not like millionaires are getting minted every single day unless you work for Anthropic or OpenAI or something like that, right? You're likely turning down good clients who just don't have enough to invest with you. And worse than kind of those three things combined is that you have the great wealth transfer that's going to happen and the silver tsunami of people retiring every single day that's just going to lower the assets you have on platform. Wouldn't it be great if you could suddenly grow your assets under management 10, 20, 30% in a very organic new way with your current clients and bring more clients to the table, all with a really creative solution? And I think that pitch not only resonated with Marty and folks that we met through that whole investment process, but also with Founders Arena, every single like VIP visit that we've had there has been pretty unanimously successful for us to kind of move on to a next stage where people think, hey, this is the future. Like, there is no reason the equivalent of 15% of the entire US stock market should be unmanaged, and Wealthie solved that for us. We should work with these guys.
Yeah, so let's dig into the construct, because when somebody hears what you say, you can extract some of the dormant cash in the equity in your house, but you don't have to pay the carry on it. That's like, well, how's that happen? Right. And so most people think about, okay, I can do a home equity loan. I can improve my house with that, or maybe I can invest it in something that's an opportunistic thing like a business or something like that. So tell us about the plumbing. How does all this work?
For sure. So we created a brand new product that we call a WISE agreement, or a wealth investment shared equity agreement. In a nutshell, what it allows a homeowner to do is to trade a portion of their current equity today and put those funds into a managed brokerage account and invest those dollars with their current advisor or with Wealthie. In exchange, they are trading a part of their future equity and future appreciation on their home. So one way, like we like to kind of explain it, is imagine you're at the investment table and you have 100 chips. That represents your entire net worth. And 50, 60, 70 of those chips are your home equity. Wealthie allows you to take 15 or 20 of those chips and put them into other assets that work in the way that you want it to work. So higher growth ETFs or bonds in a mutual fund or treasuries, just to generate income. So now you're putting that dormant equity to work. And then when you sell your home, refinance your home, or want to buy back the equity anytime before 30 years, you have the option to do that. And whatever those 15, 20 chips of home equity are worth in the future is what you pay, right? That's your cost of capital in this instance. So it's really like just trading out of one thing and going into the other without actually going through the full sell and settlement consequences on day one.
So to a person, it would be attractive to say, I can take this money and I can invest it in some other asset other than the increased equity in my house. So my equity in my house that presumably would increase over time.
Uh-huh.
There obviously has to be a cost to that.
Uh-huh.
How do you explain the cost?
Yeah. The way we explain the cost is one, we try to make it super transparently. We give folks tools and calculators for them to be able to like actually see, hey, you take out $100 or $200,000 or $50,000. This is what the cost is, and it depends on how your home appreciates and stuff like that. So the simplest way is to visually explain it over 1,000 versus 1,000 words. But if I have to go into the words front, it's basically this: you are sharing a portion of how your home grows. In exchange for that, Wealthie is giving you super patient investment capital to put to work in a way that meets your goals. You won't hear from us. We don't tell you when to sell your home. We're not telling you how to paint your house or anything like that. You are still functionally the owner and responsible for everything in the house. We're just helping you do an early trade. And the cost to you is a portion of whatever you traded, right? And so that's the easiest way to explain it. And then the benefit for them is they understand my eggs were all in one basket, a single mailing address. And now I've taken a few of those eggs and put them somewhere else. So when I sell this basket of eggs, whatever the eggs that Wealthie owns, that's going to be Wealthie's, and the remainder of those eggs are mine.
It's really an attractive thing that you don't have a monthly payment, right?
Mm-hmm.
So, Rodrigo, I'm going to ask you one thing. I know the answer, but it was kind of the most common question that came up across our meetings. In fact, one of the guys at Wealthie in the JP Morgan meeting I saw last week, or before I was off my feet, he brought it up again and he just geeked out on it, right? And he said to me, I was geeking out on it a little bit because he was the one kind of he's a private investor, got a fund, but he was a technical exited multi-million dollar exit, right? But he was getting into the weeds of it. But the common question that came up across most of, if not all of the visits, and I'm sure same thing in your room, right? Okay, what happens if my house goes down in market, right?
That's right.
Where's that falling into the outcome? There we go. So let's get that off the table so we can talk about everybody wanting to do this with.
Yeah, for sure. Unlike any type of like asset-backed line or securities-based line or like the more complex stuff that you see the top 1% come in, if your home goes down in value, nothing happens. We don't have what's known as a margin call, which is when whoever owns, let's say the WISE agreement in this case says, Arthur, your house went down 20%, time to sell your house, right? That does not exist in our product. Similarly, if your investment account goes down in value, no one's going to be calling you and saying, hey, time to liquidate and settle the trade. We ride with you up and down, right? And I think what I realized when creating this product was homes are two things. They're a place to live and they're a wonderful investment for people. That just doesn't need to be the entirety of their investing. But if you're going to keep those two things in line, you need to be patient and you need to be super consumer friendly. And that's how we designed the product to be, so that regardless of the ups and downs of the market, you as a homeowner have the flexibility to stay in that home. You don't need to worry if your home went up 10 or down 10%. You need to worry about doing what's best and right for you for the long term for your financial goals. And Wealthie will be there at the end when you settle. That's it. It cannot be more simple than that.
And then what happens if there's a first? You just do the free equity calculation. And if there's a mortgage, it doesn't have any relevance on what you're doing. There just needs to be free equity, right?
That's right. That's right. So we allow people to invest. Today, we allow people to invest up to 25% of the equity that they have in their home. If you have a first or even a second, we can be comfortable with that. We don't really take positions beyond a third. We don't ask your existing mortgage provider or HELOC provider or any other players to subordinate behind us. We actually get behind them. And so we don't impact their rights. So we don't trigger any covenants for them or anything like that. And we try to make it super simple. We are, a different type of equity investor into the home. And we basically say, hey, cool, you got this debt. We don't get any money for you paying down your mortgage or your debt, right? and we give you a patient capability to be able to invest and put this big chunky asset that's growing, anywhere from 2 to 6% in really, really hot markets long term, and go put it into the S&P 500, which is growing, 9 to, in the last year was, or this year to date, I think is like 15%, right? Like it's all about optionality and flexibility and changing the way people think about wealth in their homes, right? It shouldn't just be this passive safety net piggy bank. It should be a trampoline into building something more for yourself to put it to work. And that's effectively what we do.
It's really a dormant asset unless you leverage it, right? I think.
Yeah, so if you look at the history of like how people build wealth today with homes to access wealth, you sell it entirely. Well, a lot of people don't necessarily want to do that. You have to take on debt, and that can be really cumbersome. Monthly payments, interest charges, you have to do full pull downs, things like that. Or you have these other like really hard products called HEIs or home equity investments. And, those have a place in the market, to be abundantly clear, but they're also really expensive. They're for people who don't qualify for any other traditional product and don't want to sell, and they can charge up to 18 to 22%. And so we said, there's got to be something else different here. And part of it also comes from personal story of the fact that my parents in 2008 lost their house and we were foreclosed upon and we were homeless as a result. And my parents bought the house that I grew up in 1988. In 2008, lost it because they missed a couple $100 in mortgage payments because they were small business owners. And it's one thing to say that was the financial crisis. It's another when 8 years later, my dad passes away suddenly, Social Security gets cut, and my mom, despite having $150,000, $200,000 in equity in her home, gets a check for $3,500 and gets booted out. And I, as the youngest son, step in to financially support her. It hit me like a ton of bricks to the face that the way we build wealth with our homes and tie our financial future to one mailing address is not good financial advice. And so we said, what are things that like we just categorically don't want in the product? Monthly payments, crazy financing charges where you're getting charged 6-8%, crazy costs per year, all these things. Like we just wanted to try to make it as consumer friendly and as palatable to capital markets and to find that like intermediary between the two. And I think we've really done that with Wealthie.
So, it's instructive to talk about what happens when things go wrong. Mm-hmm. So let's start with the underwrite. How do you underwrite this sort of thing, if that's the right word to use?
Yeah, it definitely is. Across, let's say 100% of underwriting, right, of all the things that we do and the magic behind the product, I would say 15 to 20% of it is the homeowner. The rest is really the home. We want to know, like, is the home in good condition? Well, one, where is the home? Is it in a really high risk area, like a flood zone or something like that? Then, we have to look at insurance, can we get named on it, et cetera, just in the event of a downside scenario, right? How much debt do you have on the home? Are you making those monthly payments? Are you keeping the home in good order? Are you keeping insurance on the home? Are you doing kind of all the things that are responsible? Are you paying your taxes on the home? Is there a lien on the home? Is there, all that type of stuff. Once we underwrite that, we actually run it through what's known as an AVM, an automated valuation model. And we go out and we look at not only one, but sometimes multiple. And we say, what is a very confident price that we have in this house? So Zillow, for example, might say your home is worth $500,000 or $1 million. And our AVM could say, hey, we have a 90% confidence or 95% or 80% confidence that it's worth 450 or 480 or 950 or 980 or $1,050,000, right? It can go above the Zillow estimate just in that instance. And so we underwrite like all the qualitative elements of it, and then we price the home. And then the most important thing is we find out how much debt is on them. And and then after that, it's incredibly simple. Value of the home, your existing debt, that's how much home equity you have. So let's say it's $100,000 or, $500,000. You multiply that by 25%. And that is what we're willing to allow you to invest in.
So you've got a 75% buffer, assuming you're at par and it doesn't depreciate.
Yeah, that's exactly right. Right. Like, and I think part of why we can be so much cheaper than other products on the market is I think for three reasons. One, there is so much kind of equity ahead of us. And yet, if a home decreases in value substantially, we can still lose, right? Like there is still real risk of loss for the product. And there's no fixed amount that you have to pay us back, right? Like you do $100,000, it doesn't say the minimum you will owe us is 100,000. You could owe us 50 if your home depreciates in an insignificant value. Two, the way we manage risk is categorically better than any single real estate product in my mind in the history of the market. And that's because not only do we have a lot of collateral on the home, but we actually collateralize against the investment account in the event of default. So if a homeowner stops paying their mortgage or they don't pay their taxes or they just generally commit fraud or whatever, we design the product to get out of the foreclosure process and out of what is a potentially bad or spiraling situation for the homeowner as fast as possible and as painlessly as possible. So we can close the investment account, pay back, all or the majority of the WISE agreement, and then we can make a decision. Can we just release the entire lien on the house? Well, in a really bad downside scenario where 15% of the market is defaulting, your money never went anywhere if you're a capital provider because it's in the investment account. And then for the homeowner, it's actually really beneficial because they didn't go YOLO it on a Rolex or a Patek Philippe or a BMW or gamble it away. It was put in a really responsible asset. And so with those two things in mind, that gives us better risk. The third thing is we try to be conservative in our underwriting and very disciplined in how we look at things. And so we have kind of our own unique proprietary methodology of how we look at those properties. We integrate a lot of AI, which allows us to go into a broader form of the market than what a smaller mortgage shop or something like that might traditionally look at. We really use a lot of technology to say we can go into places where potentially others might not be able to.
So what happens when somebody attempts to take a second and it eats into that, what let's just say is arguably static margin on the equity? Do you get alerted somehow?
Yeah, because so if it wasn't clear, we do put a lien on the house. As a result of us being on the lien, if someone tries to, they would have to try to seek to what's known as like subordinate us, which basically says, hey, they want to get in line ahead of us to get paid, right? So what we do is we actually say, to make it simple for homeowners, say you have $1 million, I'm just going to use million and 500,000 because they're big, easy numbers for especially my smooth brain to understand. So say you have $1 million and $500,000 of mortgage and debt on the house. And over time, you start paying down your mortgage. And one day you own $300,000 of debt on the property and you want to refinance back up to $500,000, you don't even need to tell. We're fine because we attached ourselves to the 500K point. If you try to go above and beyond that, then you have to tell us, and you can either settle the trade with us, or we can look to consider modifying the terms of the WISE agreement. Very likely you're going to settle with us. But we try to make it as consumer friendly and as easy for folks to be able to buy, because we don't look at a home, let alone any of our partners, as a one-time transaction. We think a home is a 30, 40-year wealth journey. And so we try to provide that type of like flexibility from our product approach from day one.
So without disclosing anything proprietary, can we talk a little bit about how the capital markets look at this? Because you have to get the capital from somewhere, right?
Yeah, for sure. So there is a lot of, I would say, like similar products because of these HEIs that exist out there in the world today. They're really different. They do what's known as kind of like an option call or an option product, which basically says, hey, they might exercise this option and they add in crazy Forex structurings and stuff like that. It's great. They actually get rated. So there's a lot of securitizations around these types of products. And so you'll see that there's, $200-300 million securitizations with big institutional investors. And then they get rated, with triple B, single A, double A. And so the beauty is that the market around home equity is actually like fairly established. What's not established is making a home equity product that treats your home like a wealth asset versus a one-time cash piggy bank safety net, right? And so what's neat is we've gone and tested this product and we get a lot of indirect feedback about how it could be placed. And a lot of people look at us as potentially the safest real estate product that you could buy from an institutional standpoint once we hit scale.
It's really
Rodrigo, I have
interesting.
a question that popped up that I actually haven't asked you.
Okay.
Right. And I'm curious if we think about, savings, depending on who's got the product, right? But have you ever thought about a structure that since you're taking it out, it's going into obviously, ideally income producing products, right? So if it went
Uh-huh.
into those income producing products, right? Have
Uh-huh.
you thought on ones that might be a little higher risk in the portfolio, right? That the some of that income actually goes back into the payment of some sort. So you're kind of, am I making sense? So you got your income is producing stuff, right? So instead of that saying, hey, listen, what I'm going to do with half that income we're producing, I'm going to pay off either the first or the loan and have it go back in. That's allowing them to pay the house off faster.
Totally. So yes, and it's not something that's widely public, but happy to make it public here. We're actually developing a product that we call our mortgage accelerator. And what it allows you to do is imagine you have just a ton of equity and you're one of those homeowners who's sub 4% on your mortgage, which I think, if I have the number correct, it's close to like 60% of homeowners are sub 4% or 50% of homeowners are sub 4% on their mortgage. Well, it's not impossible to go out and take a couple $100,000 of home equity and go put it into from low risk treasury yields all the way up to structured notes and make a mortgage an entirely interest-free product for them and pay off their mortgage faster. And so when we've modeled it, we've even in some cases found we could knock off 10 to maybe almost 15 years on a 30-year mortgage without the homeowner having to do a single thing, right? Beyond just the swap. Obviously, results depend on the homeowner, their interest, their, et cetera, et cetera, et cetera. It's unique to those circumstances, but it's possible, right? And I think that's the power of putting home equity to work versus just keeping it dormant in the four walls of your home.
Actually, it's super interesting. You could take that and do one, as you suggest, Pam, pay down the mortgage, or two, have it generating income for the homeowner, right?
Yeah. And even say you don't have debt on the home, but you want to live more in retirement. Or, I'll share, I won't share the homeowner's name, but I remember in the earliest days of our product, when we were thinking through it, it was a homeowner in Las Vegas. He had 2 kids, a third on his way, 2 car payments. He and his wife made combined less than $120,000 a year. And he had around 2 to 3 weeks of cash savings. He was barely making ends meet, but he had $350,000 of home equity. And I asked him, what would it mean if we took out 100 of that and put it into a simple treasury portfolio earning 4%? You got $4,000 extra a year. So, a little over $300 a month extra. What would that do for you? And I remember him running his hands over his head and he said, Rodrigo, I would get to stop debating, do I pay my bills or do I feed my kids? And I knew that look because it's the look my parents had when we were losing our home. And I think, not at all a political comment, but, we're safety nets and kind of how involved or not is like society involved in people's personal financial situation. I really view this as a really creative way to be able to say, this isn't just for the billionaire or the ultra high net worth individual or the person who's already in wealth. This is kind of a everyday person product as well to help you do more without debt to meet your goals, right? And so that income can be just as powerful for that type of person as much as it is just someone in a good spot who wants to pay their mortgage off faster.
I would say that it's more appropriate for the person that's trying to build the wealth as opposed to the person that's already wealthy, because there's other things, right?
Yeah. They might want real estate to hedge off everything else that they're already involved in. Though I will say, funny story, I was sitting at the desk of, call it a top 15 bank in the US, and the CEO tells me, I bought a $20 million penthouse and guess how much in equities and broad form diverse assets I own? I was like, I don't know, you're baiting me. 10%? He was like, 0. This guy's a billionaire. He's like, 0. He's like, can you do a $5 or $10 million trade for me? I was like, well, if you're my family office that my long-term family office partner, yeah, sure I can, right? But like that's the thing is it really depends on who that person is.
The
The
fact
simple
pattern,
fact is,
yeah.
yeah, it really is. Home equity is in everyone's portfolio past us at a certain point. And so it's really, again, about doing more without debt to meet their goals.
So even though you have a lien on the house, is it show up as debt on my credit report?
No.
That's
In
really
fact,
important.
that's super important. And
Yeah.
if you go down the income route, right, we could actually lower your debt to income ratio. So we could actually make you look and help you kind of be more credit worthy because effectively your floor is de-risked. The consideration there for that homeowner who just wants pure income is potentially the cost of our product could be more than the income that's generated. So when you settle net, it could have been more expensive. But along the way, you had 30, potentially, if you extend out to the 30 years, you had 30 years of income flexibility and more resilience along the path. And for certain people, that's the right decision, right?
So having the combination of deploying the capital to the homeowner and putting it, rather than just giving it to them and having it dissipated to whatever they want to spend there, and you have a basically over collateralized perfected interest because you've got teeth into the investment account. Super interesting. The capital markets must see that as a very low risk deployment of capital and presumably a low cost of capital.
Yeah. I mean, there's a reason a family office led our first round, right? Is because I think they viewed it in two ways. One, they had extreme familiarity with the world of wealth and the possibility of how that works. And the reason we are an SEC registered investment advisor, and my co-founder, Anthony, who's the ex-COO of Deutsche Bank's mortgage group and a legend in the space, runs that entire side of the business, is because we view homes as wealth assets, and a lot of family offices understand that, et cetera. But then on the real estate side, right? Yeah. I mean, we've effectively created a really unique way to expose yourself almost to an index of properties versus a single mailing address. And that's as much of a problem for homeowners on this call who watch this as it is for institutions who say, I got to go buy 50 homes to then be able to have my exposure to Kansas or the Southwest. Now, you don't need to do that. Like Wealthie, we can actually help create that exposure across a market. And that does not exist today, not at scale, right? There are some companies that are trying to do that and have some level of limited success with it, but no one has been able to crack like a broader distribution strategy and exposure strategy the way we have.
And you can't trivialize the infrastructure required to make sure people pay stuff, right?
Oh.
So you don't have the burden of trying to make sure everybody pays their monthly payments because there aren't any. Right?
There aren't any, and we can tie specifically down to the home that we did the trade on and connect that directly to the investment account of where the asset is, right? And so in so many ways, part of the innovation of what we created is the innovation of what we avoid, right? We avoid ongoing normal servicing, as you might think about it. We avoid ongoing foreclosure battles because of a monthly payment, right? We avoid that consumer and that regulatory risk. We avoid the headline risk. In fact, I think the headline is, I made a solid institutional return that was responsible, and I helped a homeowner stay in their home for longer and build more wealth. Like that doesn't exist in the world where institutions are buying homes and boxing people out of markets. Ours is quite literally a do good, do well product that's attractive to both sides.
And stay in your home. Yeah.
Yeah, and you get to stay.
I also think, guys, there's another, you both know me well enough to know that my mind will work in other ways, right? But if I'm doing this, I'm taking this product and I am somebody that is not a Wall Street person, not an investment person, nothing else, right? And if I do get into a crunch where there is a little bit of hardship, right? The ability to say, this is my priority because this isn't only keeping me in my house. This is also mindset wise keeping me into retirement, right? So I as you look at the data over time, I would believe that it would give you another sense of how that default rate goes down because there's a double incentive for me to make that payment because I know that it's helping me in more than one way.
That's right. And And actually, if you think about this, so you guys asked about, Arthur, you asked like, hey, what about my first mortgage? I would argue every single mortgage provider should be racing to ask their homeowners, should you use a WISE agreement, right? Because now the home is that much more important from a wealth standpoint, and diversifying it and helping and or just giving more financial flexibility to the homeowner. And in a world where you get refied out just from a small change, this is a way to actually expand the relationship. If you work with Wealthie, this is a way to expand the relationship beyond just a mortgage and a place you cut, but rather a mortgage, a place you cut a payment to, and a broader form of wealth, right? Like, because let's be clear, no one at the end, on the first of the month is like, thank goodness I get to send my X $1,000, 2,000, 5,000, whatever mortgage payment to my company, right? But if that company is now helping you do more, or saying, hey, I can actually lower this payment and help you do other things with the money you have in there, suddenly there's more value. There's more loyalty. The mortgage itself behind it, ahead of it, is credit enhanced.
Right.
It actually is a safer pool of assets, right?
Yeah.
And I think that's the takeaway for institutions.
Well, I think it's takeaway for institutions, or even at the bank level, right? You go in there and they still try to sell you CDs and shit in the bank, right? I mean, like, it's an entirely different conversation that they have inside those branches that no one's walking into, but they all seem to be opening again.
That's right.
You know
And
what I mean?
banks generally are limited from being able to do this on their own. We always get asked like, can't a large bank come out and do this? And I'm sure with enough money can solve a lot of problems, right?
For sure.
So I'm not an arrogant enough founder to say no one can ever copy this.
Yeah.
But since the 2004 rule that was created back in the day blocked this category from ever existing, and we're the only company that has ever figured out how to do this, I will say it's hard. It takes a lot of creativity and it takes a lot of courage to build something new in the world of finance. And now offering that to your home, offering that potentially to your members, we have some major credit union partnerships combined, totaling over 25 billion in deposits from a couple firms. The cool thing is that like this can not only solve a balance sheet problem for a bank or a credit union, but it also solves a growth and like flexible and new product line problem that they have in wealth. Is if you look at wealth, there's this research that I saw from Tiburon Research and Chip Rohn, like 2/3 of all market growth in wealth is just the market, or 2/3 of all growth in the market and AUM growth is just the market. So what's that other 1/3? It's like you're battling out and seeing if you can steal someone's client or something. Nothing is organic.
Yeah.
It's the categorical most difficult place to grow. And Wealthie is really probably one of the only, if not the best solution in that regard to help people do more.
If you were in a situation and you had equity in your house and it was an emergency, you could get a home equity loan and go solve the emergency. Is there a provision in the investment account, like borrowing against your 401k, to solve an emergency situation?
Yeah. So the way traditionally, and most people are just going to stay invested. We actually allow you to pull income, interest and dividend income from the account, right? And, we're working on this feature right now, and this is part of capital markets appetite as well, is, hey, can we actually say your account is up 50% in 3 years or
Take
something,
some chips
right?
off the table.
Yeah, help people take some chips off the table and be able to go do that. Or can we actually inject a product behind that pool that then says, oh, there's $100,000 in here. You need 20? Here it is. And it's very cheap for you. And it's cheaper than you'd go get from these other guys because,
Smart.
again, multiple sources of collateral, right?
Yeah.
That's the beauty of, I think, reimagining what is possible with this dormant asset, is that it's not just this one-time trade or this one-time trade to wealth, but it's the one-time trade to wealth to then being able to use it in your everyday. And that's what we're like uniquely building. And it starts with the product that we described, but it builds up in a really fun pyramid.
And if you sold the house 4 years after executing this trade and you're in the money, at least to the extent that you thought you would be, what's that look like? Like, how do you unravel the trade?
It's super simple. When your home goes to escrow to be able to be sold and transferred to the buyer in this instance, we get notified of it. as a homeowner should also tell us, hey, I'm putting my home on sale. Like we track that and, we'll proactively reach out if that's the case, if we find out. And then, cool, your home is worth X. Our share of it is Y. Escrow kind of settles it all out and sends that money Y to us. And then we pay back investors in that instance, right? And they're thrilled, right? So we try to just inject ourselves in the normal process. It should not be meaningfully more complicated for you at the sale of your home. And you get to stay invested. You don't have to liquidate your investment account. You can stay a Wealthie client. You can use then those funds to go, help you buy the next house or stay invested and, just use your home funds, right? Like
that
maximum flexibility.
investment account is no longer encumbered.
It's no longer encumbered. It doesn't need to remain invested. You can liquidate it at that point. You can kind of do whatever you need to do. And I think, again, like it's all about like flexible, friendly, and like trying to make it as simple and clear as possible to folks.
I don't want to get too deep, but can you hypothecate that investment account?
You could hypothecate the account. I've seen rehypothecation. The hard part about hypothecation is then people want to rehypothecate because that's when you start making the asset wheel turn really quickly. So I think that's that instance where like you have a sudden urge or a need or something like that, and you need to access something. You need to access like a portion of it. That would be like a small portion of hypothecation, right? That we could consider. Today, the hypothecation feature is not available, but it's something that we definitely talk about.
Yeah, I could totally see oversimplifying it for the homeowner, but being super sophisticated in the background with some interest rate swaps, and you could do all kinds of really interesting stuff to enhance the rate of return without materially changing the risk profile.
That's right. And here's another one. If you just want just like a consumer oriented example, I was interviewing this guy who was an engineer at Apple, had, call it $2 million, $1.5 million of Apple equity. And he wanted to buy a home. And I was like, okay, well, you're going to have to sell that. You have to pay this big tax bill and stuff like that. Or one kind of unique use case that we could develop for them is, why don't you place some of that Apple stock or some of your portfolio with us? And we'll just give you the cash to go out and buy. And then like we effectively manage the exact same trade in a way, right? And so we actually have this feature that we call the AUM swap, because we find that people want to go into really different things. They want to go into annuities, or they want to go into derivatives, or they want to go into life insurance or long-term care, or they just want to go build their own hedge fund portfolio by themselves on some AI-driven website. Cool, right? Or they just need money. So what we've done is we've actually said, hey, if you have other assets that would meet the safe, simple, and responsible guidelines of what we would normally allow you to invest in, you can put that and post it on the other side of the trade near 1 for 1, right? Or 1.25 for 1. And we'll just give you the money unencumbered. And now actually that's a purely liquid form of home equity at a cheaper rate that allows you to have basically a lot more flexibility about what's in your home.
That's
you just
super cool.
AUM swap. And that advisors can continue making money on that portfolio. We tack on our fees as well, right? But now all this stuff is just fungible. Arthur, when I think my crypto background gave me an ability of seeing everything is atomic, everything is fungible, everything is tradable, then why not build products that allow that? And so that's probably when I explain that concept to people, they're like, you can do what?
Yeah. So it actually makes me think about the target market is somebody who has little or no encumbrance on their house, and you can do a dual trade. You can perfect your interest in some of the upside of the house and then provide non-coupon capital to do other stuff.
Yeah.
Did I get that right?
Yeah, I think that's right. And, our product is more expensive the more debt you have on a property. It's less expensive the less debt you have on a property, right? Because there's effectively more risk. But that said, for the capital providers as well, it's, that risk return is categorically better for them as well. And so we really view it as, especially with like folks like family offices, this is not a one-time like, hey, come fund this one thing that I'm building. It's you want to own and be a part of a platform that is unlocking the single largest, most illiquid asset in the world. And generating a whole new way of using it, right? And so home equity for an unencumbered homeowner is the exact same thing. You have a lot of equity. You don't need to cash it all out today. Cash out a portion of it. And then if you want to do another WISE agreement, we're open to that, right? If there's equity there, we're happy to help facilitate that trade too.
Yeah. And I'm imagining it could also be a hybrid. If there's substantial equity over your 25% threshold, then you could deploy some of the capital into the investment account and take some in cash.
Oh, yeah. Right. And it's, you should seek your own, like, not financial advice. You should seek your own tax advice and so on. But generally around this industry that has already done billions of dollars of home equity investment swaps, they're generally tax favorable to folks, right? Like most firms out there publicly talk about it being a deferred tax payment. So it's something that you worry about and settle into the future.
Yeah. Super cool. Pam, did we miss anything?
I don't think we missed anything, but I do have, we're here. This is an amazing audience. Arthur's reputation is unprecedented in what he does. But, I wouldn't be doing my job with Rodrigo in the program of saying, hey, Rodrigo, you got this great audience, very family office oriented. You did a great job. So as I said, if anybody's listening, right, aside from being able to use the product, what are the other things that you need? Because as the audience, as we started at the beginning, these are not companies that are startup in the sense, right? Mm-hmm. You've got a business, you're running money in that. But what are the things outside of somebody coming in, looking at the product from you? Are there other things that you need in the market? I would think the flyover states would be very good business for you.
Yeah, absolutely. Well, before I answer that, I will say also, huge fan of Founders Arena. You guys have been a fantastic partner for us, right? And nice. I think opened up doors and opportunities and even being able to have conversations like this, which are massive for us, right? And so, like, bottom of my heart, as a founder builder who's putting his soul into a company, like, that means a lot to me. Yeah, I mean, stuff that we're really looking at is, one, partnerships with family offices, true long-term relationships towards making home equity a truly liquid product and usable product for Americans, helping them do more without debt to hit their goals. I think the second thing for us is also just generally building like a deeper relationship in the real estate industry, right? It just starts with single family or multifamily. Commercials out there too, right? And being able to speak to and get advice from folks. I think the only reason we've been successful is we've had the kindness of people willing to share their thoughts and ideas about where to take the product, how to fit it unique for them. Landlords, when we've met folks there and saying, hey, we can slice a cut of your entire portfolio of properties. And that was an idea that came from a landlord, right? And we just frankly have the fortune of interviewing to be able to say, hey, let me sit on your side of the table and be helpful here. And so those are the types of things.
On that point, Rodrigo, okay, and there's nothing but controversy, but I think we should kind of look at probably a bad word, but maybe the slumlord kind of people, let them take those assets and put that money back into making those homes and those places better for the people that they use them.
Oh yeah. And even, exploring relationships with CDFIs, if you're familiar with a community development financial institution. I will say this is when we knew we were onto something. We had one pitch with one of the largest CDFIs in Texas and I think overall in the US. And in one call, they were like, we should really explore a multi-million-dollar letter of intent here and see if this fits for our homeowners. And then suddenly now we're potentially a CRA eligible product.
Yeah.
Because we're helping people way below the AMI do more. And you look at guys like Larry Fink and other big finance names, they are motivated by the fact that people are underinvested in retirement. I think it's something like 28 or 38% of homeowners don't even have a retirement account. The number of homeowners I've spoken to who tell me they can't invest or don't have a retirement, and that's just not in the cards for them, is mind-boggling because they think and are depressed of the American dream they thought they had, not realizing they traded off their retirement at the exact same time. We can help kind of reshift and rebalance towards something more.
So in the context of a good family office investor, are they looking at what's the duration and what's a good cost of capital for you?
For us, so it's easier to say when we build out all of our simulations around the product and you looked at all the heuristics around the product, what we tell people is based off of an average appreciating market, et cetera, we should expect around almost a 10.5% net IRR with an average duration of a little over 6 years, 6 to 6.5 years, right? Because we catch people in their home ownership journey, and there's always the 4 Ds of home ownership, right? There's diamonds, dependence, divorce, and death. And so life catches up to folks, but we give people that long-term view because they think of their homes generally as long-term assets. And then we have the highest collateralization rate of any real estate product that I know of, which is for every dollar you put in when we originate, there's 4x of dollars and 1x liquid dollar ahead of you that in a downside default scenario, you're protected.
Yeah. Super cool. All right. That was awesome. Thanks for doing it.
Thank you so much.
I could go on for a while, but I have to go. Pam, thank you for kindly introducing Rodrigo. I really appreciate it. And
Arthur, thank you for the time.
Thank you for the smart work and commitment. You could tell it's very
Rodrigo,
clever.
You just gave me an idea of an introduction that I think I can facilitate. Are we on the record? Are we still recording, Arthur?
We are. Yeah.
Okay.
Thanks for everybody for joining us. Till next time.
Thanks, everyone.